Hello and welcome to CommBank View Economics and Markets, where we unpack the key issues each week with expert voices from among CommBank's economists and strategists. Hello everyone, I'm your podcast host, Mandy Drury. So today, we cast our eye across the seas to the US-Iran conflict. They have paused their strikes over the weekend, while Iran and Oman also continue talks about the Strait of Hormuz. That has helped oil prices climb down from $100 a barrel, but we're not out of the woods, and even senior Trump officials have raised concerns about escalating the war. So where do we go from here? Well, let's ask some experts. We've got Dr. Madison Cartwright, who is Senior Geoeconomics Analyst, about the geopolitical implications, and then we'll turn our attention to Vivek Dhar, Head of Commodities and Sustainable Economics, on the energy price angle. So Madison, welcome to the show. You know what? We're at this point because the brief respite that we enjoyed after the memorandum of understanding was signed didn't hold. What went wrong? Why did the MOU collapse?
The MOU collapsed primarily over a disagreement of Article 5 of the Memorandum of Understanding. And this article dealt with the opening of the Strait and the administration of the Strait, both during the ceasefire period and ongoing. So what the article lays out is that, quote, Iran will make arrangements for traffic through the Strait, and that future administration of the Strait will be determined by Iran and Oman in consultation with regional partners. So that's the Gulf states, crucially not the United States. So this was quite a significant article just on its first brush. Now, from Iran's interpretation, make arrangements for traffic through the Strait meant that they would have to be consulted. That's how they interpret it. And they saying that any traffic that was coming through the Strait needed to coordinate with Tehran, and then they could make a safe passage through, and they would make those accommodations. The United States was encouraging traffic to go through a southern route. This is one that they had opened up during the war, but prior to the MOU. And providing air support, they were making a passage through Omani waters in the south. Now, Iran said that this was a violation of the Memorandum of Understanding because, according to them, Article 5 says that they are the ones who are meant to administer this. So this was the crux of the disagreement. And so in response, Iran started to attack ships that were going through this southern route, saying that it was in violation. And once they started attacking these ships, then the United States responded and things escalated from there.
So what is exactly happening with the conflict now? And I know it's fluid, I know it changes every single day, but give us a broad umbrella look at where you see the conflict in terms of how it's changed and where it's likely to go.
We've returned to a hot conflict, right? I know that we're in sort of a lull at the moment. As you mentioned earlier, we've got this sort of break, this 2-day break at the moment. But when the Memorandum of Understanding collapsed, we certainly did return to proper war. It's not at the intensity as we had in the first 40 days of the conflict, which is when the United States and Israel were pursuing a strategic bombing campaign. And this essentially means a bombing campaign designed to win a war, to end a war. So these were very significant campaigns. This failed, and the United States needed to move on, and that's how we got to the April ceasefire and eventually the June ceasefire. What we have now is not at that level of intensity, but certainly larger than anything we've had in the interim. So we've had tit-for-tat strikes, that the United States striking targets in Iran and Iran responding with carefully selected targets, but seeking not to escalate from there. So just to kind of meet the same level. And that's where the conflict is up at the moment. While we've seen a lull at the moment, this could be proved to be quite fragile. So I would caution against thinking that we're through this phase of the woods quite yet.
Mm-hmm. Indeed, to a certain extent, do you feel that President Trump is trapped here with his presidency being consumed by a conflict that he can't find a way out of right now?
Yeah, I think trapped is the best way to describe what's happening for Donald Trump in this conflict. I think there's a fundamental dynamic that has driven this conflict to date, and certainly the prevailing one at the moment, and that is that the United States has not been able to bomb itself to victory. So this strategic bombing campaign that I mentioned earlier in the conflict, this was designed to win the war. And when it became clear that not only was that not going to be successful, but also that it was going to carry enormous risks because Iran was able to respond and to retaliate in kind. Its ballistic missile program, its drone program has proven to be very effective. It's had remarkable intelligence and aiming capabilities, and it struck US bases quite devastatingly. It's also got a wealth of targets in the region, particularly when it comes to energy infrastructure, and all of that is on the table and can be threatened by Iran. If they made that very clear that they will do that. So this creates the trap, right? The United States can't just sort of have a quick sort of push to victory, nor can he sort of wear Iran down, because they have this resilience, they have this ability to respond. So on the one hand, he hasn't been able to achieve his goals, but on the other hand, he doesn't have any good military solutions. And that's the reason why, and we've consistently said, that the only pathway forward to end this conflict is a diplomatic one. But the problem there is that trust between the parties is so low, and this is going to require some concessions from the United States, and this is going to cause a face-saving problem for Donald Trump. And this is the fundamental dynamic that's making a deal so hard to reach, and that's the reason why the conflict is dragging on at this stage.
And we'll get more detail on what you think might play out in terms of a diplomatic outcome in just a second. But I'd first of all like to pick up, given that, we often talk largely about what the US side is trying to achieve, but what about Iran? At this juncture, what is Iran trying to achieve?
I think Iran is trying to solidify its position as a great power, certainly within the region. So Iran has sort of been in this limbo state since its revolution in 1979, where it has been isolated and marginalized diplomatically and politically and economically from the international community more broadly, and in the region. And Iran is a country of 90 million people. It has a very broad economy. It's very industrialized economy. And so if it weren't for this isolation, Iran would be this sort of great power, certainly within the region. And they're trying to basically solve the open question of what role is Iran going to play. They want that solved. They want to be brought in from the cold. They don't want to face this marginalization diplomatically and economically anymore. Economically, that means they will prosper. They will be able to sell their oil. They will be able to be paid in dollars if they want to be. And their economy will be able to recover. And they will then solidify themselves as a great power. What they don't want, and which is what they're faced for quite some time, with this open question of what role they're going to play, is a constant sense of insecurity. So they don't want to face the prospect of another war with Israel and the United States, for example, a year from now, just like they faced one last year in June, again, from February this year. They don't want to be in a position where they have to constantly be guarding, and they're saying, look, the Gulf is safe for all of us. It's not going to be safe for any of us. And they're going to use the leverage they have at the moment, particularly around the Strait of Hormuz, to achieve these very, very long-term goals.
So a diplomatic solution sounds like it would be obviously in everybody's interest, even though it has been surprisingly easy for Iran to dig in. What is the diplomatic solution that could be achieved, and what role might China have? Because at the moment they're also pushing for both Iran and US to resume their peace talks.
Yeah, so I mean, given what Iran's goals are, they do need a diplomatic outcome with the United States, because that end of economic and diplomatic isolation can only come from the United States. So they need to have a deal. That is the incentive then, to have a deal from Iran. That having said, they don't necessarily need to rush to that, because the longer they can keep the strait closed and the longer they can roll this out, right, the more pressure that will build on the United States. So that's the way they view themselves at the moment. That sort of time is on their side. But ultimately, what is in their best interest is a deal. What could be in that deal? Well, it would be very similar to what we saw with the memorandum of understanding, because that was a pathway to an end of this isolation. The lifting of the sanctions, all sanctions, was what said in the MOU, a release of all of their frozen assets. So this was laying the groundwork for a full integration of Iran back into the global economy, and that's ultimately what they wanted. So the memorandum of understanding really is the type of deal that we need. The problem is that it collapsed. So we're going to need something a little bit more now. In particular, Iran's going to need something a little bit more now, and that's going to be, we believe, a focus on sort of upfront concessions, because they don't trust the United States. They don't believe the United States will follow through on its promises. So when it comes to something like the release of the frozen assets under the memorandum of understanding, that was meant to be done on the implementation of the MOU. What I think is more likely now is Iran would probably demand those release of frozen assets up front as a precondition, right, for future negotiations, because they want those irreversible concessions made up front. when it comes to China, China obviously has an interest in, well, energy markets. We'll hear from Viv later on and the way that they've managed this crisis. But obviously they are exposed, but they're also exposed by the rest of the global economy. China is very dependent on exports for growth, increasingly so. And so anything that threatens the global economy, threatens their export market, will threaten their economy by extension. So that's one of their main concerns. They are friendly with Iran. They buy Iranian oil, but this is really a relationship of mutual benefit, and it's opportunistic. So that is to say that China has a vested interest in seeing Iran prevail because they have friendly relations with Iran, and this ultimately does weaken the United States, and that is in China's geopolitical interests. But they are not in a position to dictate to Tehran or tell Tehran what to do. And so I think that China has been trying to play a positive role, trying to encourage diplomacy. It's been asked by others in the region to play that role as well. They've met with Saudi officials, for example, that have encouraged them to play that role. And there's certainly something they can do that's positive here, but they're not in a position to solve this problem for anybody.
Indeed, and they've also got a tradition of trying not to intervene too much in other countries' affairs. So a diplomatic solution it sounds like it's quite difficult, isn't it, when there's so much distrust on both sides. So give us a few likely scenarios, because it sounds like there's a number of roads that this conflict could take. What are the most likely scenarios that we're going to see in the coming weeks and months, Madison?
So our most likely scenario that we think is going to play out is that we will see a sort of grind in the conflict on for another 2 months or so. I think in order to get to a diplomatic solution, we really need these costs to build, because there is not a great deal of appetite at the moment, particularly on the United States side, to offer up the concessions that will be required in order to get Iran back to the table. And Iran is in a position where they're wanting to push that as much as they can. So what I was talking about earlier, a release of frozen assets up front, that's going to be a very politically difficult thing for the Trump administration to do. Iran hasn't made any concrete demands, but they they could be expected to make a demand like, for example, the United States starts withdrawing some of its naval forces in the region as a guarantee that they won't then try to resume attacks. That would be very difficult to see. Iran might make Lebanon again a red line and demand the withdrawal of Israeli forces from southern Lebanon as a precondition, for example, and that would also be very difficult for the United States to deliver on. So all of this is to say that this is, diplomatically speaking and politically speaking, very, very hard to achieve, and you're going to need a great deal of incentive to get that there, and that's the reason why we think that will happen in about 2 months or so, right, when those pressures are at that sufficient level to really bring those parties to the table. It should be noted also that Iran is facing its own economic pressures with the blockade, and we would need those pressures to build as well to sort of incentivize it to come to the table. So that's the sort of base cases, if you will. That's what we think is the most likely outcome. We do think there is a significant risk, however, that we do see escalation from here. So last week, there was a lot of chatter of an escalation because we saw additional resources and military assets, US military assets being brought to the region, the sort of thing that you see ahead of a very large-scale attack. In fact, some of these resources coming in were the sort of thing you see ahead of a ground invasion. That's why some people were talking about that. Now, it seems that Donald Trump was seriously considering an escalation of some kind, and his advisors managed to talk him back from that. There are concerns over exposure of US in the region, particularly its stockpiles of interceptors. So these are the missiles that defend against missiles. Essentially, they shoot missiles out of the sky, and these stockpiles are running low. So this is diminishing the US's ability to protect its bases, its troops, and its assets in the region. But having said all that, as we were talking about earlier, Donald Trump is trapped. And when leaders, particularly leaders of great powers, of which, of course, the United States is, find themselves trapped in this way, they can start to consider options that are riskier. They can start to, psychologically play down some of the risks. And that does create the potential for an escalation from there. Especially as now we're seeing Iranian proxies in Yemen, the Houthis coming involved. This is an escalation in the conflict. And that is another field where we can see the United States becoming more involved, for example, and then how will Iran respond, etc. So this potential escalation is there, and I think that's a significant risk, and we shouldn't downplay that. what I think is very unlikely, but possible, is that we do have a quicker resolution, one that opens the Strait of Hormuz, a new diplomatic understanding in the short term, and we can kind of go back to where we were. The reason why I think that's unlikely, as I said, I think the political cost for the Trump administration in admitting defeat and making these big concessions is too great prior to any sort of serious economic trouble starting to push him that way, that I find it very hard to think that we could be looking at that in the short term.
And just briefly, the last time I spoke with you, Madison, about this particular conflict, I asked you, is it not beyond possibility that this could deteriorate to the point where we're drawing in so many other powers and we end up in something that looks like a World War III? What are your views on that now?
So I think that I still think this is very unlikely. A lot of countries are deciding to steer clear of this. I mean, we have seen some potential escalation. So Iran making threats on the UK, for example, the UK saying that they will defend their interests, etc. But at the beginning of the war, when we had the strategic bombing, we actually had a lot more powers being drawn in, right? There were drones that were shot down over Turkey, for example. Turkey is a NATO member. We had attacks on Cyprus, for example. Cyprus is a NATO member. We had attacks on bases there. There was some attacks on Azerbaijan airport. So there was a lot more powers sort of being drawn in earlier in the conflicts, and there's actually less of that now, even with this recent sort of escalation and collapse of the memorandum of understanding. But I think you can see, just like in the rhetoric of the great powers, the United States has been openly asking for assistance from Europe and from China, and there's been a very muted response coming from these powers. There's very limited appetite to get involved in this war. I think people understand that there is very limited military solutions to the problems that they face here, and the capabilities of Iran are such that people don't want to put their naval ships at risk by sending them to the Gulf, if it means that Iran is so capable and is able to sort of potentially sink these ships. So I still think it's quite unlikely we're going to see other great powers get involved from here.
We certainly hope not. Thank you so much for joining us today. It's been fascinating. Dr. Madison Cartwright. Let's turn now to Vivek. And Vivek, great to see you there. Prior to the collapse of the MOU that we've been talking about, global oil prices briefly recovered before rising sharply, even touching above $100 a barrel, their highest in 2 months. How are markets assessing this conflict now?
Sure. So look, we've actually seen a bit of two-way movement since the MOU was signed, and actually arguably three-way movement. Because when the MOU was signed, we actually saw Brent oil futures start falling. And on the 2nd of July, we saw Brent oil futures fall as low as $70 a barrel. And then when we saw the Strait of Hormuz effectively closed, and this happened when we started seeing the first attacks on ships by Iran, it was around the 7th of July, and we saw Brent oil futures start rocketing up to as high as $100 a barrel. But as of this morning, we've actually seen prices come off, and we are now back in the low 90s. So there has certainly been a lot of price volatility, a lot of price action since that MOU was signed.
You recently published a report, Viv, which noted that the market is both worried about a potentially severe shortage, while also being worried that an oversupply could quickly return if indeed things eased up. Can you talk us through that?
Sure. So look, in terms of what drove that oil price from 70 to 100, it was very much the market now repricing the idea that we could have inventory depletion play out. Now, this was an idea that was certainly the case before that memorandum of understanding was signed on the 17th of June, but it has reemerged very much since that strait was closed. Now, in terms of what the market is trying to figure out, is that when we see the Strait of Hormuz close, it's the idea that what will happen if we actually run out of global oil and refined product stockpiles. We estimate that we currently sit, as of this week, with about 9 weeks of stocks left globally. And so the market is considering that if we do run out, we may no longer see demand destruction be as timid as it has been. I would almost describe demand destruction where high prices effectively reduce demand particularly for your lower income countries. So far, the evidence has been very much controlled demand destruction. And this is things like 4-day work weeks or working from home. But what can happen if we do run out of inventories is that we no longer have inventory as part of the supply for a lot of economies. And therefore, we could see countries bid for oil very aggressively. And this is where prices can really start surging. And so it's the emerging Asian economies that have caught our attention. And when we say that, we're talking Pakistan, Bangladesh, Sri Lanka, Vietnam, Thailand, Philippines, these are the countries that are very vulnerable. Because they are low income, they only have a limited capacity to bid that oil price high enough before they have to leave the bidding process. And when we look in the past to see when we have seen those elements of demand destruction in the past, we have to go back to 2008. And if we have to replicate those conditions again now, it would mean that Brent oil futures would have to rise to about $150 a barrel. And so that is what the market, in our view, is trying to guess, should we price this or should we not? And in our view, this is more of a tail risk. This is in our base case, but you can see the market is caught thinking, are we going to run out of inventories or not? And that's been one of the key reasons we've seen this price rally, particularly last week. Now, when you talk about, okay, what has caused the prices to flip the other way, and this is what makes this like oil so volatile right now, is that if there's any hint the Strait of Hormuz is reopening, you then have to start pricing in what happens when we start seeing flows reemerge. And the market quickly starts thinking, actually, wait, we might actually see an oversupply. Now, this sounds very strange because you look at the market flipping between these two extraordinary outcomes, but it is actually quite rational for the market to believe this. And the reason being is that we have a lot of supply buffers in the market, or ways that the Strait of Hormuz doesn't actually have to be 100% of what it was before this war started. Now, this is because of pipeline bypasses. This is because of supply growth outside of OPEC plus, and it's also because of structurally lower Chinese demand. But all these three factors, and I'm happy to delve into any one of these three, but in aggregate, this means that the Strait of Hormuz traffic just needs to be about 50 to 60% of pre-war levels in order to reassert the oversupply fears that markets were expecting to drive Brent oil futures to $60 a barrel at the start of this year.
That's so interesting and quite a lot to consider there, Viv. But let me just pick up on that one scenario that you were mentioning, whereby if inventories are depleted, that Brent crude prices, in other words, the global benchmark, could rise to about 150 US dollars. How likely is that scenario?
So look, it's actually quite a tight expectation. As Madison has said, our expectation is that it will, this current intensity of this war that's playing out, or the current fighting between US and Iran, we expect that to last about 2 months. Now, if you compare 2 months with, say, 9 to 10 weeks of global oil and refined product stockpiles, it's very, very fine balance. And I would say that if anyone, either US or Iran, overplay their hand, we could certainly get to a situation where the market would have to look at 150 and consider it as this is a possibility. And to put some perspective around this, it can be so unintentional that we could see those global inventories dry up quicker than anyone expects. For example, you can look at, say, some of the attacks right now happening in, say, the Black Sea, where Kazakhstani oil is now being impeded. Now, that's about 2 million barrels a day of oil. That's about 2% of global demand. And that is enough to change the equation in terms of that global inventory depletion timeline. So you can see that there's a lot that can happen that can change this narrative. And that's how close we are. So if anything stays more disrupted than you expect, then this market can certainly look at 150 and head in that direction.
But if you'll excuse the pun, we've been here before. We've stared down the barrel of this potential concerning scenario a few months ago. So in the meantime, Viv, what structurally changed to reduce dependence on the Strait of Hormuz since the start of the war? And how will that play out in terms of global supply?
Yeah, look, the three key factors has been that we have seen the pipeline bypasses to the Strait of Hormuz. And in that, the main one has been in Saudi Arabia, the East-West pipeline, which is finding a way into the Red Sea. Now, that is giving the market a major bypass. And that is something that if we look at all the pipelines together, we're roughly talking additionally bypassing about 5 million barrels a day. Now, to put that into perspective, before this war started, about 20 million barrels a day, or a fifth of the global market, went through the Strait of Hormuz. Now, pipelines alone have basically telling you that we just need to see Strait of Hormuz traffic at 75% of pre-war levels because of just how much is coming through with spare capacity of pipelines. And so you can see that that's a major piece of the puzzle. But on top of that, the other major factor to consider is what's happening in China. So China, if you look at their stockpiles, it has been rising, but it has been rising for some time. So they were building up an inventory base, a war chest of crude oil, in order to deal with something just like the Iran war. So that has been something that has been happening in the background for a while. And that has meant that in the past, so say in 2025, their imports have been artificially higher. So they have capacity to actually structurally reduce their imports. And that wouldn't affect their economy. And that is something that is very much the market is trying to understand how big that can be. But this is the least stable of all these supply buffers because they can make sure that they reduce imports heavily when prices are high, and then they can come back to the market and buy and restock their inventory. So we would put that above $80 a barrel, China wants to sell, right? And they want to reduce their imports significantly. Whereas when we get to something like $60 a barrel, we think China will enter the market to restock. And so those are the two major reasons why we have a lot of market reprieve right now and less dependence on the Strait of Hormuz. The final factor, which is the least, is actually coming from OPEC, non-OPEC supply growth, particularly from the US. Overall, this group is adding about 1 million barrels a day extra this year. And that is something that is also giving the market some comfort. So those are the three major factors. And all up, as I said, this has meant that we only need flows through the Strait of Hormuz being 50 to 60% of pre-war levels to reassert the oversupply expectations from the start of this year.
Mm-hmm. Okay, so keenly watching China, keenly watching OPEC Plus. How much do we also need to watch what's happening over on the Red Sea coast? Because with all the issues and the blockades surrounding the Strait of Hormuz, some traffic has been diverted to the Red Sea. But what we're watching in recent news flow, Viv, is that there are increasing skirmishes between Yemen's Iran-backed Houthi rebels and Saudi sites and oil tankers over on the Red Sea coast. How much oil flow is therefore at risk on that front?
Sure. So look, in terms of what comes through the Red Sea, that has been a major bypass. So we see oil going from the east of Saudi Arabia to the west, and then it exits from a port area called Yanbu. Now, in terms of where the Houthis are and what they can attack, we're really talking about the Bab al-Mandeb Strait, which is if we see those ships head south. Now, what makes the Red Sea different compared to the Strait of Hormuz is that you can actually go up north if you really want to avoid the Houthis. And so we are seeing that being strongly considered by the market. And the issue with that is if you look at what capacity has been filled already, it means that we are going to see shipping have to change slightly. So instead of using your very large crude carriers, which can carry, say, 1.5 to 2 million barrels of oil, we may need to see smaller vessels, right, which can carry, say, only 0.7 million barrels to 1 million barrels. And that will have to go through the Suez Canal and then connect with a bigger ship and then transport through. Now, overall, everyone expecting heavy disruptions, we would caution against that. This market, the disruption in our view in the first month is just under 1 million barrels a day, right? And if from month two, our expectation is that this will drop to under zero point 0.5 million barrels a day. Once again, in terms of the number we're really trying to compare with is that 20 million barrels a day that went through the Strait of Hormuz before this war started. So you can see that there is certainly some disruption, but it is not hefty. But we are watching that space very carefully, because if we do see Yanbu attack by the Houthis, then the major bypass is gone. So it certainly warrants attention, but there is certainly ways around in terms of avoiding the Houthis. So it's definitely on our radar, but right now it doesn't change the game as we currently speak.
Yeah, it certainly feels like right now, though, it's putting a little bit of a floor under the prices, right? But bring it all home to what it means for us in Australia, Viv, because where would Aussie households and businesses feel this first? Would it be, for example, the petrol pump? Would it be diesel costs, agriculture, mining, or just even more broadly in inflation?
So look, the place you would see this and where it's really emerging is actually in that diesel price area. So in terms of what has made this situation worse, particularly for diesel, is we have seen attacks on Russian refineries. And this is something that, we're talking 2.5 to 3% of global demand in respect to the refineries that have been taken offline. And this has been significant enough to lift refined product prices, but particularly your diesel prices. On top of that, the disruption or the reopening of the Strait of Hormuz, the natural sequencing was to first see crude oil exit and then refined products would follow. So we saw a lot of crude oil exit, but we didn't see the refined products come. So, we have seen these diesel prices in particular surge on the back of these developments. And so if there's any place where we're going to see it, it's predominantly going to be in diesel. And that has its impacts on certain aspects of the economy, like mining, in some parts of agriculture, but even passenger cars. And so if we do see Australian diesel prices lift to above $3 a litre, those are the sectors that have caught our attention in terms of prices will rise enough that it'll hurt those sectors. But our view generally in terms of volume remains the same as when this war started. We believe that Australia, from a volume front, should be able to secure the volumes they need. In terms of how this plays out, if we do see inventory buffers wear down, it's usually the lower income countries that pay the most in terms of not even getting the volumes that they want. The higher income countries typically will get the volumes. They'll have to pay higher for it, but they have the capacity to pay for it. What gives Australia even more protection is that they can do deals where they can say, hey, we can give you our LNG, but for that, we want refined products. So from the volume front, we feel comfortable that Australia will be okay. But from the pricing front, our concern are a few sectors. And the question also will come now to policymakers about the excise and whether that will be on August 3 come back in full. And so that could add another 17 to 18 cents a litre. So we're watching the space pretty closely, but if we do see 70 to 18 cents and we see diesel prices continue to rise, if this conflict takes a turn for the worse, then it could start hurting some sectors more materially, and then the market will have to consider, some inflation worries. But for now, our view is that the market can handle it, and those inflation fears have been contained. But we may need to see the government come in and reduce the excise to potentially help some of the consumers. But it's a very volatile situation in terms of where policymakers act.
How confident are you that the efforts and the measures taken already by the Australian government to secure supplies, do you feel that it's been both appropriate and sufficient?
Look, from the volume front, I think they will be okay. I think that from that angle, I think Australia has an advantage. And so from that side, policy lens-wise, I think we'll be okay. We were walking into this with fewer stocks in terms of days of stockpiles than other countries. But in terms of our ability to get the volumes when we need it, I think that is a very strong part of what policymakers have achieved today.
Excellent. Thank you so much for joining us today, Vivek. Before we let you go, let's do a look ahead to what we can expect in the week coming with Michael Tang, Senior Associate Market Strategy and Rates Research at CommBank. Michael, welcome once again to the podcast. Give us your assessment of what's going on with inflation in Australia, because we're getting the Q2 CPI as an insight into that.
Yeah, that's right, Mandy. That's coming out later today. So CBA's trim mean forecast is 0.9% over the quarter, for 3.7% over the year. That's in line with consensus at the moment, but there is a risk to the upside. So according to our own internal modelling, there is a 30% chance of a 1% over the quarter result. So I think 1% would make the RBA's job a little bit trickier. The August meeting becomes a bit more line ball, and we'll certainly be looking at the details of the print to see if they want to swing one way or another. Our base case is still a hold. We think there's enough caution around the RBA board to not amplify the current housing market downturn. You've seen prices falling, clearance rates have been pretty soggy as well. That said, markets themselves are starting to stir a little bit around the prospect of an August hike. So market pricing was as high as 46% at the end of last week. That has come down a little bit to closer to 30-35% with the improvement in the oil backdrop. But last week we did have a pretty strong jobs growth print. We had jobs growth of 76,000, which caused a bit of a reassessment. I think we would caution that the jobs data can often be quite volatile, and I think our read is the unemployment rate is a bit of a better read. Underemployment and underutilization rates are also still rising. I think the RBA has been on record as saying these form a key part of their assessment of labour market conditions as well. And so that's in line with our view of a slowly cooling labour market.
If we cast our eye across the seas, why should we be watching the US Federal Reserve?
Yeah, I think the Fed meeting is going to be a very interesting one. That's definitely the showstopper for the week for Australians and non-Australians alike. So new Fed Chair Warsh has been extremely tight-lipped around how he sees the path for Fed policy. At this stage, markets are pricing in around 40% chance of a hike, but that's come up from as low as 13% as recently as 1.5 weeks ago. The Fed themselves have actually been in a communications blackout, so we haven't actually heard much from them. But it does seem like there's a real sense that the Fed could spring a surprise and actually hike 25 basis points at this meeting. Market pricing has been a bit of a volatile indicator, and I think in many ways this will be a bit of a new normal under Warsh. To take you on a bit of a journey into how we got here as well, we've actually had some pretty soft data prints. So in terms of non-farm payrolls, that was weaker than consensus. The actual household survey that feeds into the unemployment rate was also pretty soft as well. CPI, core CPI, they've all surprised to the downside as well. In fact, headline CPI did actually fall for the first time since 2020 on the monthly rate. But as part of the Fed's semi-annual testimony to the House and the Senate, Warsh did actually say in response to the downside beat in CPI that it wasn't mission accomplished, and there was a commitment to restoring price stability. So I think Warsh is definitely making all the right noises, but I think one other risk is also, he's all talk and no walk, which would be bad news for the US bond market as well. You start bringing in all these questions around central bank credibility, and these inflation risks will also start to show up in term premia as well. So right after the Fed meeting, we actually do get US core PCE as well. That's tracking at 3.4% currently over the year, and consensus is for that to fall a little bit to 3.3%. But I think that is still well above the Fed's inflation target, which, as a reminder, is 2%. One thing worth noting, though, is Warsh has been on record, and he has 5 task forces, one of which is on inflation and inflation frameworks. He has said that he prefers trimmed averages. And based on the indicators that are available at the moment, it does show by those measures, inflation is a lot lower than what core PCE would be showing. So it kind of does beg the question around what's the angle here as well. And I think a lot of the task forces, you feel that there is something or an answer that Warsh might be looking for a little bit. So you have this risk of on both sides of either Warsh is ready to go and hike next meeting, or there is still that Trump factor and this possibility of pushing for lower rates and or looking for a justification to hold rates for a longer time than perhaps is necessary for the economy.
It's a bit of a fine line to walk, isn't it? What about the BOE and the BOJ, Bank of England and the Bank of Japan?
Yeah, so the Bank of England, I think, is a little bit more straightforward. They're expected to hold the bank rate at 3.75% this week. The meeting's on Thursday. And there's just under 2 hikes priced for the remainder of the year for the Bank of England. So for the UK, I think it's a relatively standard response to the oil shock that's happening. It's about how much and when to tighten policy in response. It is worth noting that the UK has had a new PM come in, Andy Burnham. He sat in that seat for about a week and a half now. He has made some comments around looking for any flexibility around the UK's fiscal rules, which is perhaps a bit less comforting for gilt markets. On Japan, again, I think on the face of it, there's not much going into this meeting. I think the expectation is for rates to be held at 1%, but there's a lot going on beneath the surface. I think there's this sort of quip out there in markets that there are 4 types of economies: developing, developed, Argentina, and Japan. And I think a lot of that is sort of ringing true at the moment as well. I think markets are definitely in the position that the Bank of Japan is well behind on its job, and rates do need to go higher. And, the Bank of Japan actually has come out recently and acknowledged themselves that they might need to move more quickly. They might need to hike rates more than once every 6 months. And a big part of that is, due to what's happening with the currency. So the Ministry of Finance in Japan actually spent 11.7 trillion yen, or around 74 billion US dollars, to support the currency in late April, early May. But I have to say, I think the return on investment has been pretty poor. It did touch 164. So the yen touched 164 against the US dollar last week. That's the weakest level since 1986. Essentially, the fundamentals aren't really there for yen strength. There's this issue of market perception, but that interest rate differential to the other economies is also very, very wide, which makes investing in Japan relatively less attractive. On that note, Japanese government bonds have actually been setting all kinds of unwanted records as well. So 10-year yields are at 30-year highs. 30-year yields are at the highest since their debut in 1999. And when we have yields this high, it means that bond prices are falling. Ordinarily, if you're an investor, you see these kinds of yields, you think that looks attractive. And that usually would act as a support for the currency as well. But the issue now between, yields are going higher, but the currency is weakening at the same time. In essence, I think markets investors aren't really convinced that even now is a safe entry point to invest into say government bonds. A large part because there's a risk that the inflation task will run away from the Bank of Japan. The other issue is fiscal dominance in Japan, where the central bank again isn't hiking as much as it should, but this is less around inflation. This is more around how much government debt is out there on issue. It's been fine during the period where inflation was relatively stable, growth was relatively low, and interest rates were relatively low. But now there's a risk of hiking rates triggering issues in terms of government interest costs and government issuance costs. Japanese Prime Minister Takaishi herself has shown little sign of exercising spending restraint as well, which does make the job for the Bank of Japan harder as well. So I think across everything today, there is this connective theme as well of monetary and fiscal credibility coming under scrutiny. I think 2 weeks ago, Adam was on this podcast and he did speak a lot about, particularly I think Japan and the US and the reaction of markets as well. So a lot of countries obviously have had inflation outside of targets for arguably quite a long time. There's definitely a growing risk now as well from oil as well that inflation continues to remain away from target, which really starts to reset inflation expectations. It makes the market question a central bank's readiness for the task as well. You add to that the fiscal spending, and this does have implications for the short and long end of the bond curve. But I think in the short term, it is a hard job for a central bank. There's all these rolling supply shocks. The oil story at the moment does make it very hard to be data dependent as well as a lot of these central banks would probably prefer, and they need to be much more reactive.
Michael, thank you very much for that really detailed look ahead to what we can expect in the markets. Michael Tang, Senior Associate Market Strategy and Rates Research. And thank you so much for joining us for today's episode of CommBank View. Make sure that you join us for your weekly analysis on what's shaping and shifting economies and markets. I'm Mandy Drury.